Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 120. Well, with 2024 right around the corner, what does that mean? That means experts are putting out their top stock picks, and should we even care? Well, today we're going to go over some of those. We'll talk about if you should care, and we'll talk about some of the theories of the past 40 years, like the dogs of the Dow theory, and how you should think about all these picks and how possibly you could use it to your advantage when it comes to designing your portfolio. So get your mind right and let's get to work.
You drunk this.
All right, well, welcome back to the show, everybody. Sorry I didn't drop an episode last week. That is when the professor side of the Investor Professor comes up. I had finals this past week. A lot of students, a lot of emails, and maybe some new listeners. Hey, Jessica. I usually don't tell my students that I do this whole thing until at the end of the semester. And they're paying good money to see me live, so I don't tell them that they can keep this up until later on. So it's always kind of fun. Of course, I'm sure if they Google me, which most of them do, they probably figure it out pretty quick. But here we are, 2024 almost in the books, and so we'll take a look at some stuff. Let's do a market update. I just want to remind you of where we were last year at this time. So last year, 2022, the S&P 500 was down 19.4%. The Dow Jones was down 8.8%. And the NASDAQ composite was down 33.1%. Okay, so that's where we were last year, 2022, into the year. This year, the Dow Jones is up 12.5%. The S&P 500 is up, I believe, let's see, so I'm not making up numbers. S&P 500 right now is up 22.91%. And the NASDAQ, get ready for this, NASDAQ is currently up 41.5%. So a complete turnaround from where we were last year. And it's times like these where we're doing so well, everything's working, that I remind myself of the pain that I felt a year ago to keep myself humble and to make me realize how quickly it can turn around. So last year, when times were horrible, worst year I've ever had as a professional, I thought, okay, this can turn around. This year, tremendous year, doing really well in almost every portfolio. I'm sitting here thinking it can always turn around. So we're never too high, never too low, right in the middle. We stay even keel, and we just keep pressing on. And I bring that up because, we're going to talk about everybody's predictions for the new year. There's a lot of companies that have put out their top stock picks for 2024. And this is the does it even matter? There's not a, if you go back and look at the end of 2022, there are not a lot of experts who thought that 2023 was going to be a good year. And if you look at a lot of professional money managers, you look at a lot of the professional hedge funds out there, they're all trailing the market. They were not expecting the market to do very much this year. And so it really comes down to, having your strategy, making good choices, and just sticking with them. It's the consistency. It is I'm going to continue to invest. I'm going to believe in something. I'm going to continue to believe in these companies. And I'm just going to stay the course. And it's really just about staying the course. So this past week was really good. We had the Fed's final meeting of the year. And this is when you really saw, some stocks really start to take off. You had Jerome Powell and the Federal Reserve. They kept interest rates where they are. But for the first time, they signaled that there might be some rate cuts coming in 2024. And just the hint of this right? Just the hint of this caused the market to rally in certain sectors, especially industrials. And you have to remember, like, why is this so important? And so if you think back to conversations that we've had, when analysts are looking at stocks, they look at future profits of a company. Well, interest rates are a drag on those future profits because you have to discount those. You have to discount those profits back. Let's say 10 years in the future, you're discounting them back to today, and you use whatever the interest rate is. Well, the higher the interest rate, the lower those profits are going to be. This is a time value of money calculation that drives everybody crazy. So when they lower interest rates, that means that their profits in the future are going to be worth more today. So everything gets adjusted based on these interest rates. And is it annoying? Yeah, it's really annoying. But is that how the computers and algorithms work? Yes, that's how the computers and the algorithms work. And so there's not somebody manually doing it. If you'll remember, 50% of all the trading that happens in the market is computerized trading. So, there's not, there's numbers and there's equations, but there's not a whole lot of intuition and logic based on this. So you have to be careful with that. But if you know it, you can kind of use it to your advantage. So you look at different companies, like you look at United Rentals. So United Rentals, it's not a sexy company. It's not one you're going to hear a lot about. But Monday it traded at $500, and by the end of the week it was at $572. And if you look on Wednesday when the Fed meeting happened, it just started to skyrocket. And so, you'll see that some of these industrial companies that borrow a lot of money, their equipment's really expensive, all of these things, if the Fed lowers interest rates, also, obviously that makes their borrowing costs less. All of these things kind of work together. And so the Fed's going to have to be very careful with this because there hasn't been a lot of, obviously real estate activity, people buying houses. And, if they lower interest rates once and everybody goes out and buys a house, that means they're probably going to start slow rolling, continuing to lower interest rates. There's a lot of pent up demand in people to go buy houses. And that's because, millennials, large generation, everybody's wanting to buy a house. There's a lot of people who are like, I'm not going to buy a house. I'm going to see if the Fed lowers rates. And so, you have to be careful. You have to be careful with that because it's probably not going to be lowered near as much as maybe the expectations are. So it's like everything. It's just a grain of salt. It's one component when we look at companies to invest in. It's one piece of the puzzle, if you will. And so all that taken together, we start making recommendations. But again, you still, no matter what, you want to invest in the best companies. You want to invest in the companies that are going to be able to do well no matter what the circumstances are. And then maybe you take 10 to 20% of your portfolio and you kind of go based off some of this current event stuff that's happening. The United Rentals that I just mentioned there. Okay, so I went and I looked for companies, and we're getting close to 2024, which means, as I said in the beginning, everybody's making their stock picks for the new year. And I really caution you on this. So when I was younger, I would buy all the magazines at the end of the year. So like Money Magazine, Kiplinger's, all the magazines when they would come out on what their stock picks were for the year. And I would read them, and then I would put them in a drawer. And I would go back and I would look at them because I'm weird like that. I would go back and I would look at them a year later and see how they did. Like, how did they do on their stock picks? And literally, I would guess most of the time, they were always about 50-50. They were 50-50 on did they do well and 50, that they did bad. There was never really, I could not gain any kind of statistical advantage on reading a certain magazine over another. They were always about 50-50. And so that is my caution to you. Is that, you start seeing all these picks and it really is about a 50-50 shot. There's another one that I think I did a whole episode on it called the Dogs of the Dow, which the Dogs of the Dow is a theory, came out in about 1991, that says you should basically buy the highest paying dividend stocks available in the Dow Jones, meaning that because the stock didn't have a good year, maybe it came down, it comes down, its yield goes up, right? Because the stock price, or sorry, the dividend yield isn't impacted by the stock price. So as a company's stock price comes down, its yield will go up. And so the Dogs of the Dow theory is basically, if you buy the companies that didn't do well in the Dow Jones, so they have a higher yield, that'll basically reverse to the mean, and they'll have a good year the next year. And so you can look at some of the charts and see how they did. But if you look at this year's Dogs of the Dow, it's Verizon, it's Walgreens, it's Chevron, JP Morgan Chase, and some of these probably will do pretty well. Intel's on the list, IBM, Amgen, Cisco. There's 10 of them, and that's kind of what the theory says, is you buy the 10 highest yielding. But some of these, when it comes to investing in a company, like we always say, right? Number one, you have to understand how the company makes money. You have to understand how the company you're investing in makes money. That is like the most fundamental thing. How do they make money? Could you explain it to a kid, right? You want to know how a company makes money. And then, as you go down the list and you're looking at certain financial metrics, do they have cash? Do they have a lot of debt? Like how are the financials of a company? But really, and that one gets a little bit complex. But the other one I always think about is, what is the catalyst? Like, what is the reason this stock is going to go up? And there's some of these companies that are in the Dogs of the Dow that one of the worries that you would have to think about is, are they even going to be in the Dow Jones? It's not like the companies in the Dow Jones are there forever. You can go back, you can look, you can see when they make changes. You can go back and look at the Dow Jones in 1976. That might be going too far back. Let's go to like 1988. Is that too far back? 1980s, and you look at the companies that are in the Dow. Some of those companies, you don't even recognize them, okay? So I look at this, and the one that stands out to me is Walgreens. And I think about Walgreens and CVS, and I think I've mentioned it on here before, but I really wonder if both of those companies will be around in 10 years. They are old. Walgreens is a very old American company, but Amazon is just, there's just so much competition. I just wonder if they'll be, the same. I can't find a catalyst for investing in Walgreens. I just cannot find one. And I could totally be wrong. I have been wrong before. I've been wrong many, many times. It's not about being right or being wrong. It's just, I just don't see a catalyst for investing in Walgreens. 3M is another one that I've gone around with people on. 3M, you might not know you might know the name. You might not know their largest or their number one product. Their number one product is Post-it notes. And congratulations to them. The internet did not kill Post-it notes. They do very well. But it's another one where it's like, what is the catalyst for them? IBM, oh my gosh, that stock has been flat for years. For like 5 years, IBM's been flat. It's big. They don't really know which business. They're trying to take care of the old business while work on the new business. It's like the story of a company that gets huge, does fantastic, and then gets so big that it's like clunky and it can't make the moves that it used to. But there are some on here. Like Chevron looks pretty good. JP Morgan looks pretty good. And so, when you think about like these theories, like Dogs of the Dow, it's not a hard, fast rule. It's something you should consider. And then you kind of use that, and then you use your own brain and you kind of deduct what you want to invest in looking at these certain companies. And so, it's all of it is just kind of not hard, fast rules, but something that you can use to kind of help yourself. So let's look and see what some of the companies have said that you should invest in. So let's see here. Let's go with Forbes. So Forbes top 10 best picks for 2024 include Visa, McDonald's, Taiwan Semiconductor, Microsoft, Adobe, Bookings.com, which that used to be Priceline. So Priceline and Bookings are together. Apple's on the list, Monster Beverage, and Union Pacific. So interesting enough, fun fact about Apple. So Apple's market cap, which is currently, I think they crossed 3 trillion. I think they did. Let me see. They did. $3 trillion market cap. Like Apple's market cap is almost larger than the entire stock market of France. Like Apple alone is almost larger than the entire stock market of France. I mean, let that sink in a little bit. I mean, that is absolutely crazy. And I'm telling you, I have run Apple stock. I mean, it's my number one personal holding is Apple. I haven't even added to it recently, but I mean, it just keeps going up. So it just stays number one. But every time I run the valuation on that, I mean, looking at the metrics, looking at everything, I mean, as long as, things stay the same, I mean, in 7 to 10 years, I mean, I don't know. It's a $500 a share stock unless they split it. And so, right now it's at 196. And I mean, I look at that. So when I'm buying these, I'm thinking, okay, I'm investing $196 for $500 in 7 to 10 years. I mean, that's how I look at it. And so it's really, habits are hard to break. And the number of people who have iPhones and all the stuff that goes in with it and all of those things, I mean, it's just, the habits are hard to break, man. I mean, and you're investing in people's habits. So the other ones on their list, Visa, McDonald's, I can see those. Taiwan Semiconductor, Adobe. Looks like a pretty good list. Monster Beverage, which another fun fact, if you look like over the last 10 to 20 years, the number one stock you could have invested in was Monster Beverage. And so Union Pacific Railroad, that would be one that the lowering of interest rates would definitely impact. Bernstein, Alliance Bernstein comes out. Their top picks are Uber, Broadcom, Pinduoduo, and a company called Grab, which I haven't looked at a lot. I think they're the Asian version of, I don't know, not Uber, but the Asian version of Grubhub, I think is who they would be. So that's always a good strategy too. Like just looking at what companies have done well here and then go look around the world and find the companies that do that same thing somewhere else. It's one of the main reasons I was able to find Mercado Libre before a lot of people. So that's definitely a good strategy. JP Morgan came out with their top picks. Their top picks are Amazon, Google, Uber, Match.com, and Vizio. So, I mean, they're not really going out on a limb here. I mean, there's not, nobody's like throwing themselves on the sword of like, I don't know, Snowflake or I don't know. Like it doesn't seem like anybody's really taking a risk picking Amazon and Google. Uber, maybe. I mean, that's one we've talked about that a number of episodes we've talked about Uber. And I talked about this in my classes this semester. I mean, if you can find companies and invest in them before they become very profitable or before they reach profitability, I mean, you can really do a tremendous job for yourself finding companies before other people do, and then you can really kind of ride them. You can really ride them into that profitability, and then they get added to the S&P 500 like Uber did, and so, it's a great place to look. So here we go. Let's see, Goldman Sachs, top 15 picks. Jeez. They have Berkshire Hathaway on here, Goldman Sachs, United Healthcare, Meta, Google, Tesla. I mean, it's, they're just hitting the same names. Visa's on here again. I mean, it's hard if you go look at the credit card companies. I mean, they have such a, they have such a stranglehold on the movement of money. They have Amazon on here, Nvidia, Microsoft, and Apple. Goldman Sachs top picks are Apple, Microsoft, Nvidia, Amazon, and Visa. That is crazy to me. I mean, yeah, those companies are probably going to do well. So you think about the Magnificent Seven that have done so well this year. Are they going to continue? Are they going to continue? They probably will. Or are they going to have the same year last year that they have this year? I'm not sure. I like the pick of Amazon because Amazon still is not at its high back from 2021. So Amazon's high, I believe, in 2021 was about $180 a share. Yeah, 180, let's say, in 2021. Right now, they're 150. So being 150 right now and still haven't got back to where they were to their all-time high. And the NASDAQ still is not back to its all-time high in 2021. So there's a lot of room to run here still that would probably surprise a lot of people. So, you're probably not going to get hurt on some of these names. I think personally, some of the companies I'm looking at are companies like Morgan Stanley, companies like Goldman Sachs. These are companies that do a lot of IPOs, and the IPO market has not been doing well for the last couple of years. I'm not saying it's going to do well next year, but those are the kind of names where I'm thinking like 2 years out, 3 years out. Morgan Stanley, I get a 3.7% dividend. They're doing I think a $25 billion buyback. And so I'm just like planting seeds for like what I'm going to be making money on 2 to 3 years from now. So you have to think about like, what are you doing? What are you investing in that's maybe not on everybody else's radar, but you think you can, maybe get there before everybody else. And that is like the key. That is the key to having really good returns in your portfolio, is getting some names that are under the radar right now that will be on the radar for people later on. So for this year, I've seen Uber ranked in like 3 different rankings as far as their top pick for 2024. Well, us getting into that early this year before it hits everybody's radar, that's when you make some serious returns. So, it's fun to look and see what people's top picks are. I always think it's good because sometimes you see names that you aren't familiar with. And so it allows you to be able to look and say, hey, I don't know what that company is. I'm going to go find out what that company's all about. Let me see what they do. So it can kind of put other names onto your radar. But it's not something that you just take what somebody's top picks are and you say, I'm going to do everything that's on this list. It's still going to be, at best a 50-50 proposition. So it's a good starting place. But then again, you got to do your own homework. You got to put in the time. You got to see what these companies are about and then decide if they're right for you or not. So we'll go with that. All right. So next week we're going to talk about goals as we get into the end of the year, into 2024. I'm going to bust out my my goal sheets and we'll see how we did, even some from years past. So we'll discuss that. I hope this was helpful for you. Hope you had a great couple weeks. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.